Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update from Monday, October 24th, 2022. It is 3:19 p.m. Eastern Time. I'm starting the video, so it'll be a brief one. I don't know if it'll make it out before the close or not. I'll shoot for that. I'm not going to go over too much. I just need to reiterate, and again, I can't emphasize the importance. This is going to be a big week, most likely going to be a volatile week. You have the market-leading FANG stocks reporting. You have Microsoft and Alphabet tomorrow, Tuesday, after the market close. You've got, let's see, Apple's on Thursday after the market close. Amazon's on Thursday after the market closes. And you have Meta, what is that, on the 26th, on Wednesday after the market closes. So a lot of big market-moving stocks this week. Really all of them, the FANGs. And so volatility can cut both ways. Volatility can be strong moves to the upside, strong move to the downside. It usually entails both back and forth swings. And so the bottom line, expect volatility. You know, if it's not your cup of tea, just stand aside. Let the dust settle this week. Of course, you have the FOMC meeting next Wednesday at 2 p.m. So we'll probably continue to see volatility. And what's happened lately, there just seems to be a growing consensus or belief that the Fed is going to back off, whether it's outright, and maybe not cut the full 75 that everyone was expecting. My guess is they'll either do the 75 and give some pretty straightforward verbiage that they're going to maybe wait and see at that point, or reduce rates. It's going to be something to the fact where they will, I believe, and that's what the market's pricing, and at least back off from their previous extremely hawkish talk about continuing to raise rates throughout the year, more and more 75 basis point cuts coming. And again, we'll see if they say anything on quantitative tightening. I've already shared my guesses as to what that they're going to pivot. But again, I put nothing above this Fed. They're the same folks that put us into this mess. And I've said over the years, the only thing you can count on the Fed being predictable with is being behind the curve, doing too much, waiting too long to cut rates, and then too long to raise rates when need be to slow things down. So here we are. Let's just talk the technicals, and I'll wrap this up. So again, market leading stocks reporting this week. There's going to be some volatility. This is that 60-minute chart I got out to you last week with the purple lines, key levels. So this morning, remember, we were right here, and that's the chart I got out to you. Ran into the, I'm trying to get my circle tool. Right there, we hit the purple downtrend line, the primary downtrend line, and also that previous reaction high when we spiked above there. Had to pull back to that level. Told you reaction was likely because that's what we're doing. We're ping-ponging between these levels. But then we went on to we took out that high, and now we're coming up to the next one. So here it is. By the time you get the video, we'll most likely have hit, well, we maybe just did. Yeah, we just did pretty much. High of 279.40. I have the line at 279.56. That's that gap right there. This is where they're going to step in and sell. So that's an objective level to short to get a pullback trade. And you have this little wedge forming. So you had this uptrend line right here off the low that we broke. We tested this gap. There was a big gap right there. Made a test to the top of the gap, and we've been drifting up. So that's probably the most likely scenario. Again, this is micro stuff, but it's fun or profitable if you want to trade these little rips and dips. Come on, back test the trend line again. And then where we go from there, I don't know. You can see we have some potential divergence. We need to turn down here, and we'll have negative divergence on the 60-minute chart. If it plays out, that would indicate that the market's not going to like what the big fangs are selling when they report earnings and give guidance this week. But who knows? It's always a crapshoot. And I can say there's not a single, not even remotely close to a single week in earnings as important as this one. Every quarter, every 3 months, the same week, you have these same things. They all report together at the same week. The ones I just mentioned, Apple, Microsoft, Alphabet, and the like. So anyway, so just hang on, see where it goes. Now let's talk about what's happened. All right, not what may happen. And anything can happen. I don't know. It's going to be likely some volatility, maybe an explosive move to the upside, maybe an explosive move to the downside, and the bear market resumes. What I can tell you, if you turn off all the lines and everything else, since this little washout move on the big inflation data back here on the 13th of October, we've been zigzagging or stair-stepping higher. It's been somewhat erratic, but you can see the trend is up, a series of higher highs and higher lows. That's a very near-term trend. Obviously, the longer-term trend, since the Nasdaq peaked back in November and the S&P peaked around the beginning of the year, that's bearish. So we have a bearish intermediate to longer-term trend and a bullish near-term trend. Now, the most important thing, Bud, is we're coming off with a step out to a longer time frame. Remember, this bullish near-term trend, what it's done is it's firming up. Remember a couple weeks back I told you we had potential divergence? Now it's confirmed divergence. The PPO has clearly made a bullish crossover, and it's put in this big divergent low. This is the stuff from a technical perspective. Again, and I've been saying this for weeks, this is by far, without a close second, the most bullish technical setup on the markets if this plays out. I don't know. I keep having mixed thoughts. I think maybe it won't play out. Maybe they'll sell into it. I gave you the analog from back in 2008 when we had the same kind of divergent low. We had almost the same rally. I did that in a video a week ago, I believe. It was almost like everything was almost exactly the same. Scary part on that is, I warned early on in this bear market. I said, look, we can short those bounce backs to the 200. That's just basic stuff. And this everything has played out so far almost uncanny, both in the the two counter trend rallies, the back test of the 200 days, how far they went in percentage terms, how long it was since the Nasdaq topped back then in '08, or it was '07 they topped in October. Here was just after that, so about a month behind. And again, we're at a very similar point, and even down to where we had the positive divergence on the daily and weekly chart back in '08, and we got about a 10% rally, and then the bottom fell out and the divergences were taken out. Does it happen again? Well, since I all I can say is I don't know. I can say it's pretty easy. The way to trade, it's easy, because if it does, if we reverse here after this week, and especially in the next week, I don't know if it does happen. Is it going to be too fast to jump on? Maybe, maybe not. But that's what you want to look for. I've been saying this for a while now. A break of those lows is going to be bearish. It's going to have undone, if it happens, all this here. It'll undo that bullish crossover. It could take out the divergences. Likewise, if the market likes what the FANGs are selling when they report, overall, on balance, remember, they're different companies. One of them will probably get sold down, and the others will probably get bought up after earnings. So collectively, you have to see and again, don't put too much weight into if they beat. They almost always beat. Companies have made it more of a science in recent decades, how to manage earnings, manage it with the analysts and all that. So usually you're going to beat. But again, it's more about the guidance and what's under the hood when they do the conference call and all that. And then the most important thing is, how does the market react? All right, so sometimes they beat and the stocks go down. Sometimes they miss and the stock rallies. And there's more to just meeting or beating or missing the top line, earnings. There's all the under the hood, how many iPhones did Apple sell, how many iPads, what's their subscriber rates for their, other products. They make a lot of their money off their app store, obviously, and their apps and all that. And we'll see. So let's see what happens. Right now it's constructive. And then you look at the weekly chart, and again, as of now, this is nothing but bullish check marks. It could be undone. It could be undone in a single day. But we had T3 was hit here. We had our nice rally. We hit it again. We had that 1 week undercut right there, followed by recovery. The fact that we recovered is very bullish on face value, and as long as that lasts, because that was a bear trap. You had a break of support, followed by recovery, reversal back above. We don't have it yet, but you can see if they can build on these gains, you're going to get a bullish crossover in the PPO, and it's going to confirm what I consider unconfirmed divergence. We have a higher low in the MACD, just like on the RSI, but until you get that bearish PPO crossover, we could still turn back down. Sometimes these lines look like they're going to cross and you get rejected. But as of now, the setup is there, and most importantly, you're back above the previous mid-June lows in the bear market, and you're above the recent lows when we took it out and then recovered it. So that's it. And the targets, if we do bounce, are going to be up here. Minimum target, you have a downtrend line. You also have a comparable trend line on SPY in the 200-day moving averages, and so that's like a magnet if unless we get sold into here on the earnings. So again, I've been saying this for about the last week. or so, maybe last 2 weeks, that the risks to me are bilateral, meaning equal odds, like coin toss odds. So I don't want to, I keep sharing my thoughts. One day I'm here, down here, but like I say, it's minute by minute, play by play. Odds change, just like when you're betting horses. Until the betting closes, the odds are changing by the minute based on how the bets are coming in. And so now today, look at this. We took out this previous high right here, has been taken out, and that's bullish. It keeps it builds on this case. Well, it's not a case, it's fact that you're in a near-term uptrend. When you start taking out previous highs and put in lower highs or higher lows as well, that's an uptrend. So, and that also then starts to firm up or continues to firm up those daily and weekly charts. It could all be taken away in one fell swoop, depending on what earnings do. Maybe we'll have a good idea, I suspect, after the big fangs report this week, but maybe not. You still have the most important thing right now, more important than earnings than anything, is the Fed. That's what the markets are hyper focused on, and so that that is going to push us out almost another week, a week from this Wednesday until that's out of the way. Once that's out of the way, well, the thing about it, if this bullish setup or these bullish technicals fall apart, well, guess what? By the time the Fed announcement's over, if unless the market's going lower, we'll probably already be up to that bounce target. Again, the downtrend line and the 200 days, which are just above. You look at it on SPY, the S&P 500. My lines load here. There's your downtrend line right there, and it's nice and clean on the S&P 500. You have the high in the beginning of the year, that reaction high. There's the 200-day simple, the 200-day exponential, and then the downtrend line. Let me just measure it out for you. That is, if that's going to be hit, then that means the S&P 500 to hit the downtrend line, depending if and when we get there, it's about another 9% higher. Again, if and when we get there. I say that because a downtrend line is dynamic. It comes in at a lower and lower price every day. So if we hit it, in this period of time, within a few weeks, that's 9%. If we take out the lows there, remember the downside, my downside targets, I'm waffled on that, and I still think they'll be hit. It's just a matter of we're going to rally first. T4 is my next target here, around 235, and that would be very fast. If we get, I think if the lows get taken out, you'll just probably drop down there in pretty quickly, within a week or so, matter of days most likely. So that's it. No, not much else to add. You can go to the short-term time frames if you're an active trader and swing this. This is the 10-minute chart I've been telling you lately. Just look for these divergent lows right there. There's our most recent divergent low, was also on a back test. You see a trend line right there. You had a recent high right here. It was that divergent high. You had a reaction there. You took it out. And then you back tested it there. You back tested again with positive divergence in place. And that's taken us up to this previous reaction high. Again, that's resistance on QQQ as I start out in the video. So we'll probably get a rejection there today. And that's it. Really, I don't have much more to add. Everything's set up. The market's either going to take off here soon or go down. You look at the volatility indicators, like the VIX. Everything is poised to break out, but it hasn't done so yet. This is my daily chart of the VIX. You have the primary downtrend line right here that was taken out. A little fuzzy. I'm not crazy about that, but then there's a near-term downtrend line right here. Here, you can zoom in here and you can see that one. You got this high right here, this one, 2, that's 3 reactions, 4 reactions, 5, 6, and then a big level here at about 37.61. This is what's capped all pops in the VIX, which coincide with corrections in the stock market. Since COVID hit, there's COVID right there, and that would be the big level. As I like to say, resistance is resistance until it's taken out. So, if we're going to rally up to those levels that I showed you on the S&P 500 and QQQ, then that's probably going to coincide with a pullback to this trend line right here in the VIX, right? It makes sense. VIX is almost, it's not exactly like a upside down chart of the S&P, but it's similar. And likewise, if the divergences crap out, get taken out, and we have another leg down, we take out the recent lows, we're going to have an explosive move up. The VIX will spike, shoot up probably to those, that's where previous bear markets ended, all the way up here at about 88.68. We've only hit that level twice in decades, and that was at the end of the 2008 a 2007 to 2009 bear market. Technically, it was a NASDAQ 100 bottomed in November. Every other index had a slightly lower low in March, but there was that big sell-off in November that spiked when you finally bottomed. You had a little bit lower level on the VIX, but that was it. That was a multi-year high right there. And then when COVID hit, same thing. So these are my indicators. Unless we see some kind of surge like this, I can say with a pretty high degree of confidence, there's never any certainty. The bear market's not over. We spike up there. I still don't think the bear market will be over. I think people think it's over. I think we've entered a multi-year bear market, unlike the others. The others were so, when I say the others, I'm talking going back decades. The last two, to me, the last two real bear markets, COVID doesn't even count. It was that 2007 to 2009, and then the dot-com bubble when it burst in March of 2000 down to 2002. Those were the last true bear markets, and they were, less than 2 years. This time around, or 2 years, give or take. I think the last one was 18 months, something like that. And this one I think is going to play out a lot different because we have, in the case, one of many other reasons is we've entered a new secular bull market in interest rates. We're coming off a 40-something year secular bear market in rates where rates were going lower. And by just about every technical indicator and measure, we're now in the early stages of a new rising market. And the stock market, for the most part, trades inversely to interest rates. So we're probably looking at something akin to Japan. You look at the lost decade, which is really technically 2 lost decades. That's probably what's going to be like. Now, I, as a trader, welcome it because even if you look at the Nikkei going back from the 90s and 2000s, early 2000s, the bear market rallies are they're bull markets within a secular bear market. So there's just so much more money to be made in a bear market because the bull market rallies are fast. You get in a matter of weeks or months what takes years in a bull market to making gains. And then likewise, there's, on the downside, you can make tremendous profits shorting. So, while I don't wish ill on the U.S. economy or the global economy, again, I welcome bear markets because they're very prosperous to trade. Traders like volatility. And so that's where we're at. So near term, I don't have much else to tell you. I'll have hopefully my thoughts on where we go will start to firm up as the week goes on. But again, you have to take every little move with a grain of salt. Every little breakout that occurs this week and after these big fangs start to report, every little break of support or breakout above resistance, take it with a grain of salt. But collectively, if you have more big rallies, that's bullish. It's going to firm up the charts. And then we just have to maybe reduce positioning before the Fed announcement on next Wednesday because that can reverse whatever trend we get out of this week with the FANG earnings, whether it's bullish or bearish. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.